Hey guys, Professor Romani again with another video from Chapter 3 of your Corporate Finance textbook. So we finished most of Chapter 3 in the live lecture in class today. So we'll go over some handout problems. These are problems straight from the back of your textbook chapter. Okay. So let's start with the first question in some sense. So cash flows. What impact will the following actions have on the firm's cash balance sheet? Firm sells some goods from the inventory. Well, for you could think about your current assets this way. Hold on 1 second, hold on. Okay, so this is your firm's assets, and under that you have current assets. Yay. Under that you have cash, and then you have accounts receivable, and then you have inventory. Okay, so the question asks what happens to the firm's cash, and you sell some inventory decreases and the money goes straight to the cash. So the cash balance increases. B is the firm sells some machinery to the bank. Firm sells some machinery to the bank and leases it back for a period of 20 years. Okay, so that's your question there. And let's go back. So what will happen here? Think about it for a minute. Okay, it sells the machinery and leases it back. Okay, so again, now you have increased so it has machinery roughly falls under the property, plant, and equipment. You have some machines. You sell the machine now, so your cash balance will increase right away. Okay, and the lease payments will happen over several years. Okay, so in your net income statement, you'll be paying, it will be slightly lower by you're freeing up some cash right now but you'll be paying some sort of lease expense. And so your future profits will be slightly lower over time. But right now, your cash is much higher. And for part C, firm buys back 1 million shares from existing shareholders. What happens here? Okay, so think about it in your liabilities plus equity, or in your equity statement, you try and do liabilities plus equity. And the equity, you have some sort of like common equity. And you're using your cash balance to buy back some of that equity. Okay, so that means cash balance goes down right away. So that's question 8. Now let's go to question number 9. So I assume you all have the statement in your OWL, so I'm not going to go spend too much time. I assume that you could always have them open in your computer. The share capital was $1.1 million and retained earnings were $3 million. And the other comprehensive income is $400,000 and total equity is $4.5 million. Year-end retained earnings are 3.3 and so on. Okay, so there's a bunch of numbers which are given here, and net earnings are 900. Other comprehensive income is $0. Okay, so let's start with this. Question number 9. Okay, so in 2017, the share capital was 1.1 million. Retained earnings 3 million. Accumulated other comprehensive income, 400,000, and total equity is 4.5 million. Okay, so the year-end 2018 retained earnings was 3.3 million. Net income was 900,000. Another comprehensive income, 0. And there were no stock repurchases or stock issues during that year. So what were the dividends paid by the firm in 2018? So this is your question over here. So if you try and think about it, so what is retained earnings? Retained earnings for a particular year. Retained earnings is an accumulation of past profitability or past earnings, right? So retained earnings can be thought of as the retained earnings from the previous year plus whatever net income they earned in the particular 2018 year, plus whatever other comprehensive income as well they earned that year, minus whatever amounts they spend in terms of dividends, minus repurchases. And again, you could also think about that. Yeah, so this is assuming when there are no new stock issues or repurchases. This is how the retained earnings in the end of the balance sheet gets paid. Let's see if we can fill this up. 2017 retained earnings was 3 million. Right, so 2018 is 3.3 million. 2017 is 3 million. Net income 2018 is 900,000. But the comprehensive income was 0 minus dividends. And repurchases were given as. So from this, the dividends for 2018 would be that would be 600,000. Okay, so the next question, which I'll work out on, is the question number 21. There's a small financial statement given here. And this financial statement, I'll quickly copy that down. Or make sure you have your handout open. So we'll be answering a bunch of questions based on this financial statement. Okay, so question number 21. So question number 21, what is shareholder equity in 2017 and 2018? Being asked. So the balance sheet in 2017 is given to you. Shareholder equity over here, also assets as liabilities. Okay, so for 2017, that would be current assets plus 890 minus 650. Shareholder equity is 240. Okay, so what's the shareholder equity for 2018? It's going to be shareholder equity from the previous year, 40, plus net income from 2018, just 1950 minus 1030, 350, 250. So what's the net income for 2018? Okay, so, or is there a more direct way? Is balance sheet given for 2018? Oh, balance sheet is actually given for 2018, so you don't need to go down this way. So shareholder equity for 2018 is just 1050. That's the assets, total assets from 2018 minus 810. Okay, that's going to be 240 again. Sorry, 230 again. 230, 240. Oh, this is 1040. Okay, so question number B now, 21B. What is the net working capital in 2017 and 18? So what is net working capital again? Okay, net working capital, or simply just known as working capital, is the amount of money which you need to maintain. Oh, and formula wise, right? Net working capital is just the difference between current assets minus current liabilities. That's the formula equation. So whatever you have in your current assets minus current liabilities is the net working capital. And typically this needs to be positive in some sort of value. And net working capital is in current assets, you primarily have some sort of cash, some sort of inventory, so and so. And here you have accounts payable is your biggest thing. You have accounts receivable as well. And the difference between these two is the amount of money which you kind of always need to have on hand in case you want to quickly increase your inventory, you have to quickly pay your wages, you have to quickly pay your supplier, and so on and so. And these are usually within 3 months, 6 months rotations. You always need to kind of have this on hold. And for 2017, it's current assets minus current liabilities. Current assets is 90, current liabilities is 50. 40 for 2018, and this is 140 minus 60. Okay, so net working capital has kind of increased. So you needed more, you had kind of had more money here. And so parts, now 21 part C. What is the taxable income paid in 2018? Assuming the firm pays a 35% tax rate. Okay, so 2018 revenue was 1950. Cost of goods sold is 1030. An expense. Depreciation also an expense, 350. And interest expense is 240. So if you subtract all these things, this will become earnings before taxes. So 1950 minus 1030 would be 950, 920. 920 minus 350. 575, yeah, 570. 570 minus 240. Okay, so that will be your earnings before taxes, and taxes are 35% of that. That would be $115.5, and your final net income is going to be the remaining. Okay. It's 1114.5. So the next question will be part D. What's the cash flow provided by operations during 2018? So what is cash flow by operations? Okay, so we are looking at interest in, so cash flow is not the same as net income. So we just talked about it in class. So it's not the same as 114.5. So here depreciation over here is technically not a cash outflow if you can think about it. So what is cash flow? From operations, in some sense, can be thought of as from net income. You add back depreciation. Okay, so that's your, and then you subtract out increases in working capital. Okay. So net income was so this is 214.5. So net income was 214.5. Add back depreciation, which is 350. 350. And you subtract out increases in working capital. So working capital from 2017 to 2018 increased by 40. You subtract that out, and that's going to give you 24.5. That's part D now. Part E. What must have been Southeast's gross investment in fixed assets during 2018? Okay, so let's look at the balance sheet again. The net fixed assets, in 2017, it was 800,000 or million, 800 million, and in 2018, this jumped to 900 million. Okay, so this is the final value at the end of each year in terms of how much fixed assets, or what's the value of the fixed assets they have. So when you try and think about fixed assets, or fixed assets in 1 year, it's going to be the fixed assets in 2017, minus if you try and think about whatever, plus investment in fixed assets. Or you could also call this as capital expenditure. And you subtract out depreciation. Okay, so this in some sense, the gross increase, if you try and think about it, is you add back depreciation because that's not the net investment. So yeah. So this was 2018, this was 900 and this was 800. This capex is what we are asked to find out, and plus depreciation. Wait, I'm getting confused with the sign now. No, this is minus here. So this would be capex minus depreciation, and depreciation is 350. So capital expenditure is going to be 900 minus 800 plus 350, and that's going to be 450. Okay, so the idea is you invested 450, you made new investments of 450, and so think of your net fixed assets in 2018 as 2017 the net fixed assets was 800. Temporarily it went up to 800 plus 450, which is 1250, and then from that you subtracted depreciation of 350, and so the final value is like 900. Okay, so that's it for part D. So this is just like trying to review your accounting, nothing else. Like we're just reviewing all your accounting which you studied before. And now part F is if South Sea reduced its accounts payable by 35 million during 2018, what must have happened to its other current liabilities? Okay, so your current liabilities in the current liabilities is 60 and 50 over here. Okay, so on your question says it reduced its accounts payable by 35 million during 2018. Right, so from here to here, whatever assets over here, the accounts payable went down by 35 million. Okay, so current liabilities for 2018 is current liabilities for 2017 plus any increase in accounts payable, increase in, I don't know, current liabilities during 2018, right? And this is given, so this is 60, this is 50, and this increase is what we're trying to say. So this net difference is 10. Okay, and this increase in current liabilities can be thought of as the decrease in accounts payable plus increase in other current liabilities. I'm going to try and split it that way. So this is going to be 10 is minus 35 plus increase in other current liabilities. So the increase in other current liabilities is going to be 45. Okay, so this one more G and there's more questions. It's another challenging question which you could kind of review yourself, and it'll be helpful to stay on top of remembering all your accounting, just to help you in the future chapters. And that's it for today. And keep practicing these questions and attempt your quiz as well. All right, I'll see you all in the next video.